Hello, this is Michael Ball, Managing Director at Weatherstone Capital Management, with a market update as of April 2021. Here's a brief overview of the things that we plan to cover today. We'll look at an update of where things are currently standing with COVID, both with cases, vaccine rollouts, and things of that nature. We will take a look at some of the concerns over renewed inflation that have driven several of the most important bond indexes to their worst quarterly performance since the end of 1981. And then we will further take a look at our approach to fixed income investing in this environment. Then turning to stocks, we'll take a look at some of the longer term challenges that still remain out there in regards to valuations. And then as a possible solution to some of those challenges, we'll take a look at some of the potential trends between U.S. and foreign investments that we've seen in the past, and also between growth and value stocks that may give us some areas that have good opportunities. When we look at COVID trends in the U.S., we're currently having an increasingly positive picture. First, we've seen both the number of cases and fatalities drop significantly from where they were just a few months ago, as shown on the chart on the left-hand side. Second, we're seeing COVID vaccinations moving at a good pace, and that the U.S., based upon the vaccinations and the people who have already had COVID, we're able to get pretty close to the target zone for herd immunity, as is shown on the chart on the right-hand side. This should be able to help the country get back to more of a pre-COVID normalcy here as we start to move through the summer months. We do recognize that in some of the areas of the world, we're seeing renewed surges in COVID, particularly in places like India. So the picture is not quite as positive overall on a global basis, but at least inside the U.S. and for the U.S. economy, we're looking much more positive than at any point since the COVID crisis began. An additional encouraging sign for the U.S. is the pace of our population getting vaccinated. The chart shown here takes a look at where the U.S. ranks in comparison with other major countries around the world in terms of the percentage of population that's vaccinated. And so we can look at, compared to most other countries, we're doing a very good job, and that pace has been quite consistent. It's actually continuing to pick up a little bit of pace here over time. So one more encouraging picture for the outlook. I wanted to include a graphical chart to look at the global economy and the economic declines and recoveries overall by various countries as well as regions around the world. This chart is looking at the data and color-coded as a heat map using the Purchasing Managers Index from countries around the world to measure economic growth and weakness. With the color coding, red's bad, meaning economic contraction, yellow is stagnation, and green is positive momentum. The varying shades of the colors indicate the strength or weakness in those different areas. The data goes back far enough to show the global financial crisis from 2008 and 2009, which gives us a good comparison. While the economic declines in many respects were deeper during the COVID decline than they were during the global financial crisis, the rebound has generally been quite a bit quicker due to the extensive government stimulus from around the world, as well as the decline being caused by kind of a catastrophic event versus a breakdown in economic fundamentals and larger underlying problems that took place during the global financial crisis. We can see that on a broad-based view, both the developed and emerging market economies are back to positive momentum, as shown there on the top of the chart. And when we look at the different countries, as we start to go down, the U.S. is a bright green and has some of the strongest growth across the major economies. The data does indicate, as you look, that although there are headwinds in certain areas of the world, the economies globally are tending to bounce back quicker and moving back to a growth trajectory quicker than they were coming out of the global financial crisis. As the economy's rebounded, we've seen rising concerns over inflation becoming a problem. This has caused the bond market to perform quite poorly so far in 2021, with the Barclays Aggregate Bond Index posting its worst quarter of performance since 1981. We went into this topic in greater detail in our quarterly newsletter, which is included in the quarterly statements that go out from E-Trade as well as on our website. If you'd like to take a look at the expanded commentary, you'll find it on our website. But I wanted to show a couple of graphs that can show what's going on. On the left-hand side of this chart, we see the forecast for inflation for the next 5 years. That expectation has rebounded significantly over the past year, and it's now nearing the highest levels since 2017. On the right-hand side of the chart, we have a graph that is showing the changes in annual inflation. The average rate of inflation over the past 3 years, which is 1.6%, and then the target longer-term rate for inflation by the Federal Reserve, which is 2%. The Federal Reserve during the past year has said that they would be willing to let inflation run at an above average level in order to make up for past years in which inflation ran below 2%. So in order to get there over the next few years, we need to see inflation run closer to about 2.4% in order to bring that average back to 2%. One of the things about this that's been disconcerting to the bond market and bond market investors is that in the past, the Federal Reserve has tended to wait too long to begin hiking interest rates, and inflation has started to get somewhat out of control, so that the Federal Reserve has had to hike interest rates more than expected, which becomes even more disruptive to the bond market in order to get things under control. So the bottom line is that the increased uncertainty has significantly slowed down the amount of money moving into bonds at a time when the U.S. government is running record budget deficits, and that's putting even more pressure on interest rates. This chart gives you a picture of where interest rates have been over the past 10 years. The dark blue line, kind of in the center there, is where we're currently at. The purple line is where things were at late last summer when rates were kind of at their lows across the full yield curve. The grayed out areas are kind of the ranges that we have seen over the past 10 years. So, rates have moved up a fair amount since where they were last summer. We're back quite a bit closer to that middle of the range, and if we see inflation kind of move much beyond the Fed's target range, we could see some of those yield curve levels shift back up to towards some of the higher levels. That's part of the reason why in many of our fixed income holdings, we've tended to prefer things that are either floating rate in nature or else tend to be more shorter duration in terms of the time that they have to maturity, because the longer you have an interest rate that's locked in, the more negatively it tends to be impacted when interest rates go up over time. One longer-term challenge from the environment of very low interest rates and high stock market valuations is that if you look at a mix of the valuation for both stocks and bonds, there are some challenges because you have the expected return from bonds being towards the lower end of where yields have been over the past 10 to 20 years, and the valuation for stocks is near the upper end. And so when we look then at kind of how those are combined together and look at how that compares with times that we have seen over the past 30 or 35 years, we're certainly on the lower end. And typically one of the main benefits of diversification is that if one of the asset classes like stocks is doing poorly, the other asset class may be able to make up for the disappointing performance of the other. But where both of these are at lower expected returns, there's not as much of a shock absorber as what we have seen in the past. And so this is one of the challenges we look forward that we look at and say, okay, how do we need to potentially manage this in the coming years? When we look at these valuation metrics and say, is it a problem right now? Uh, the chart we're showing here gives you a pretty good picture of kind of the time frame over which these things start to become more important. The chart on the left side looks at how the current valuation level impacts the returns over the next 12 months. And so the orange line that cuts through there is basically the regression line that shows that as valuations go higher, expected returns go lower. The gray dots are basically what the actual returns turned out to be. And as you can see, they're spread all over the chart. So it's not very tightly clustered. But when we move out and look at that over a 5-year time frame, then we tend to see that the dots are clustered much more closely around the regression line. And so while in the short term that may or may not have much of an impact, as we start to go out further over an economic cycle, then it does start to play into that. And so we're at a high enough 5-year valuation that the expected return for stocks is certainly below average from what we're used to seeing. While the high valuation for U.S. stocks may be a headwind for equity investors, it's important to consider the fact that equity valuations are not high across the globe. We talked about this some in our last quarterly update, and I wanted to touch upon it again and show a different chart that shows how stock market leadership can shift between the U.S. and foreign markets in cycles that can tend to last for quite some time. As shown in this chart, which goes back basically to 1970, you can see the differentials from when U.S. stocks outperform, which is kind of the gray colored area, versus when international stocks outperform, which is the purple colored areas. And so there tend to be regular cycles between those. The current cycle that we're seeing is actually the longest in which you've seen U.S. stocks outperform foreign stocks by a significant period of time. It's also the second widest margin of outperformance that we've seen. So some could argue that that's fairly well stretched there. But when you then look at the fact that foreign stocks are cheaper than U.S., if we start to see a shift take place once again, we could see a strong period of outperformance by foreign stocks that could help to make up for some of the lower than expected returns from U.S. stocks. So if we can potentially reallocate at opportune times to benefit from that shift in performance, that can minimize some of the potentially lower rate of returns that a person might have if they were focused real heavily on just U.S. stocks. We also see trends in outperformance between growth stocks and value stocks in the U.S. Although the trends tend to be more erratic than the domestic versus international trends, as we see on the chart above on the left-hand side, over the past 20 years, there's been some significant periods of outperformance by both growth stocks and then value stocks. Although value stocks have recently begun to outperform, they've been lagging growth stocks quite consistently for more than 5 years. When we look at the level that value stocks are above or below kind of the horizontal line there, it basically shows that there's also a pretty good level of undervaluation by value stocks relative to growth stocks. So that if we do begin to see more of a broad-based market advance and stronger economic recovery, we could see some pretty strong growth from those areas, which would also help to make up for some potentially lower returns from the high valuation in U.S. stocks. So in summary, the U.S. economy is picking up steam, and we're starting to see some good light at the end of the tunnel in terms of normalization to get back to more of a pre-COVID type of an economy. Pressure on interest rates has started to become a challenge for bond market investors. It may temporarily benefit the stock market because money that has otherwise been going into bonds in recent months and years may start to shift into stocks until there's some concerns and people get skittish about the stock market. Valuation concerns are something that we need to be cognizant of as we look over the next several years. But during a period of below average interest rates and when we have significant economic stimulus, having high valuations alone is not likely to to stop the current stock market advance. And even knowing that we do have some of these challenges out there, we do see pockets of opportunity in places like international, different areas of value stocks and things of that nature that will look to potentially increase their weightings in investment portfolios if the opportunities are attractive relative to what we're currently holding in the investment portfolio. With that, thank you very much for taking the time to listen. Please give us a call or send an email if you have further questions or would like to discuss things further. Thank you.